This is Robert Kraft, and I'm your host on SNN.Network. And with me today for this Wall Street View is Sam Namiri from Ridgewood Investments. Sam, welcome back, man. Good to see you. Happy New Year.
Good to be back here, Bobby. Happy New Year.
All right, all right. So I wanted to start off this interview today before we get into the article that you wrote for the magazine, which is why I invited you back on. Let's get your quick background. Tell us a little bit about yourself.
Sure. So I studied engineering at UC Berkeley, and then I started a jewelry company where I had a factory overseas and had contract manufacturing also in China. Eventually, I went to business school and I left that business and joined a small and microcap hedge fund out in the New York area, and eventually joined Ridgewood and managed their microcap fund. So that's my quick, I don't know, 30-second background.
There you go. Don't worry. If people want to hear the full back, we could go into that. But we got a lot to cover with this article today because
Yes.
I think this is a fun one that we talked about writing for the magazine. So, title of the article was "Inaccurate Negative Blog Articles Creating Opportunity for Long-Term Investors." There's a lot to unpack here. Let's start with why you wanted to write about this subject.
Why I wanted to write about it was because I've just seen this myself as a great opportunity to find good companies trading at that usually trade at a very high valuation, an expensive valuation for a normal value investor. But this is a great opportunity to be able to find these companies and get them at good valuations.
Mm-hmm.
And so I've had a handful myself that I've found in the past, and I thought, why not share it with others, to see, because again, I think we'll get into it, but it's actually very difficult, and these negative articles are actually very, very well written, where it's really hard to see through what they're actually writing about and get to what the real truth is and what the real long-term truth is. And so a lot of them are actually very successful in the short term. So it's just, again, I think it's important to share, not just because it'll help others find these opportunities as well too, or look for them, but I think it's, once I see an opportunity like this, I share it with my network of investors that I talk to as an idea generator. And so the more we can talk to others and see these articles, I hope others can share with me, any ideas that they find as well too. So if you ever, come about a negative blog article where you're just like, you know what, like this does seem scary on the surface, but I know this company very, very well, and a lot of this, the what they're writing about is either not material or it's, not even true. It's like kind of borderline true, where it makes it look bad, but it's not really, it isn't really true at the end of the day.
Mm-hmm.
And so, if you have any ideas or you see a negative article written about something, feel free to contact me.
so, so for I really want to get into the thesis of this. Like what happened, and please do not name the companies that maybe you experienced this with, and this of course. But what was this thesis when you first saw this? Were you doing research on the company and you saw, hey, the current stock price doesn't really match what I'm seeing on the valuation side. Like, why is this happening? Or was it a company that you owned and you were like, why is it down 20% today on literally nothing?
So the first time that I saw a company that this happened to it was a company that I had an investment in for 4 years, and I had more than doubled my money over that 4-year period. And I sold it, and the stock kept going up and up and up. And I sold it because I thought the valuation was expensive and it kind of had run ahead of itself. And I was happy to sell it. And even though the stock went higher afterwards, I still felt comfortable at the price I sold it because I felt I sold it at a reasonable, logical price. And I think the stock doubled again after that time period within a year. And so one of the things that I feel that these short sellers target is a company that's, performed really, really well over, a relatively short period of time. So, companies that have gone up 4 or 5x, I think is a target. And so a short seller wrote up like not even just one, but ended up writing like 5 or 6 really, really, long, well-researched articles about a company. They even got former employees to file lawsuits against the company. Like this was a very, very good, nice, nice job to like go attack the company and try to, bring about bad information, bad news, more lawsuits, a lot of regulatory agencies looking at the company as well too, due to all this. I think the New York Times wrote an article about it on I don't think it was on the paper, but it was written in a online, like a few paragraphs article about it as well too. So again, very well funded, well researched short attack on this company. But I had known this company for 4 or 5 years, and again, I liked the company. I thought it was a good business. I thought the management and the board did a really good job of capital allocation, which is why I felt it got such a nice multiple, and I guess kind of ran up a lot. But in this situation, I was able to buy it back at a lower price than when I sold it 2 years later. And I was able to, and the company had grown over that time period as well too. So, um, I felt comfortable at the price, and I knew the company as well. I didn't really need to do much more due diligence on the company, um, because I mean, multiple things is I had a relationship with management, so I could call them and they would pick up the phone, and I could ask them about a lot of the accusations that these short articles and these short write-ups, were talking about, and um, the questions they couldn't even answer, I had known myself because I had gone to the investor days. I had, visited them. I had seen them at industry trade shows where, again, like a lot of the things they pointed out were, they may have been true, but it didn't, and then they didn't matter, like, or weren't relevant or weren't material. So, a lot of these short write-ups, they talk about, okay, well, because management does business with this one company or this one person, and that one person or company has had dealings in the past with a bad character, that makes the management of this company, by association, bad as well too. And so they're like, okay, well, when you smell a rat, there usually is a rat, right? And so, or something by association, it just gets people scared. And then they point out other little things where, oh, well, they classified this expense as incorrectly, and it really should have been management compensation instead of a company expense. And like in that situation, as a shareholder, does it matter really whether it's classified as one versus the other? I don't think so, really. It matters to the manager because they get taxed differently, they get compensated differently. But again, it's a cash expense one way or the other. So it shows up on the income statement already. It shows up on the free cash flows. So maybe I'm getting a little bit ahead of myself.
No, but no. That, I mean, this is good. It's interesting. When you get into a case study, is like, why this was interesting to you and why now you're potentially looking for. Well, it's really just another form of idea generation for you at this point. It's not like you're actively looking at, oh, send me everything, but there could be nuggets in there in some of these short attacks where like, I don't know. I mean, what's interesting to me is like, I mean, how are these articles getting so much, I guess, visibility, and where this has now become a place of idea generation potentially.
Yeah. For me, it's because it's a company I already follow. And so it's visible to me because I see all the news already. And so, especially in the microcap space, it's very easy to get people scared. And especially a company where there isn't much volume, um, it it doesn't take much, to really drive the stock down. And you need to, if you can scare one big shareholder into selling their shares or to panicking, then you can really drive the stock down. And so, yeah.
Yeah,
Sorry.
I mean, in these articles themselves, the writer has to disclose whether or not they're shorting the stock or long term shareholder. It's not like they can just wield an attack without actually disclosing what their incentive might be.
Yeah.
Or is
you
that something to
do.
look out? Or is that something to look out for? I mean, if they're not disclosing whether or not they are or not, I mean that could be a signal as to wait, maybe I should question this.
Yeah, I mean, I've seen both situations. I've seen a lot of situations where the article writer doesn't even show their name. They go under some sort of like screen name. Um, so I've seen animals. I've seen like Greek gods, different things like that. Um, but but yeah, I mean, so in that situation, they could say they're short or not, but you don't even know who it is, and they hide their identity. So. Uh, Yeah, I mean, again, they're skirting the fine line as to whether what they're doing is actually legal or not. It's definitely a gray area, and so again, they could be a proxy for a short selling like a fund that's short or wants to short the company or is shorting the company. I don't know exactly what game they're necessarily playing and whether they're all playing the same, whether they're all trying to do the same thing. I must say that they usually are successful in the short term in terms of driving the stock prices down. Um, and by short term, I mean like it could even be up to like 3 months up to a year. Were they able to be successful, if not longer? I think the first one that I saw, it took about 2 years before the stock hit its low. And I actually got into it. I didn't really myself buy any shares of it until I saw a short article come out about it from the same short author, sorry. And he came out with an article, and it was the first time that the stock didn't drop when he came out with an article. And so I was like, I thought to myself, this seems to have hit bottom, and all the people who are scared and panicked, I feel, have generally gotten out already. And so I ended up buying, and I timed it pretty well in that situation, where I think within a year I was able to double my money on that one. But again, like I think that's usually an exception to the rule, and that one was like I've never seen a short write up done as well as that one, and consistent attack done as well too, where it wasn't actually a lot of the truths, a lot of stuff they talked about wasn't actually true or didn't pan out to be true. So
So in your experience, and you talked about this at the very beginning, where you're getting kind of into the minutia of like what were some signs for you as to, all right, I this might be getting into the weeds a little too, or talking about things that really I don't for you didn't matter so much to whether or not this was going to be detrimental or beneficial to the issuer or to the business that you were looking to invest in. So for my audience that maybe wasn't following the company and all of a sudden they see a short attack on a company that they just happen to come across, what are some tips and tricks that you use that are able to help you sift through the noise of like, all right, this might actually be legit versus this sounds like they're kind of pushing it a little bit here.
yeah, I mean, I would go and try to look at what are the things the company is actually doing directly,
Mm-hmm.
um, and and also how is the company reacting to it. A lot of times people get, it's natural to get very defensive about it, and then all you do is focus all your energy on attacking back instead of running your business. And so that's like a emotional reaction, and also like what again, where do you spend your time, right? Do you spend your time attacking it, or do you spend your time, again, sticking to what's going to drive value long term? I think that's one thing to look at. Another thing to look at is the really a lot of like is what's going on, like is it different than typically what happens in the industry that the company's in, or does it even matter, like I mentioned before, like the management, like whether something is a company expense or it's categorized as marketing, or is it executive compensation, or is that what they're complaining about? Is that what the short article is mentioning? Like how does it actually affect free cash flow? What a lot of times when these companies are successful in the short term, or what they target, are already public companies are regulated by the SEC. But banks are regulated by their by FINRA. Not FINRA, but banks are regulated by I forget why am I forgetting the name of the is it the FDIC, right? So like that's one of the things that banks get regulated by. Then locally they get regulated more. Insurance companies are regulated quite a bit. Healthcare is regulated quite a bit. So those are three industries that short sellers typically try to attack, from my experience. And so anything where it either is regulated quite a bit, or I think like Bill Ackman, for instance, he was trying to attack a company that did multi-level marketing. And so again, that's not a very highly regulated business, but he was trying to get regulators to go and look at that business, right? That was part of his short thesis. And so that's a lot of times what I've seen as well too, is that these short write-ups are targeted toward those highly regulated industries. So I think a lot of times they're not able to find things that the regulators actually don't approve or they would be against, but they have the regulators go in and hopefully try to find something that can actually damage the business, especially material in the short term, whether it's fines, it forces the company to take more expenses usually as well too, to be able to, handle this increased regulatory scrutiny. So again, that's why I think in the short term they are successful, because they take management focus away from running the business into handling regulatory issues, and increasing expenses to be able to handle this. But in the long term, it shouldn't, if it's a good business, it shouldn't really affect the business. And as long as, the companies are doing things legitimately, which is really the risk here is, is the company doing things where they don't where they don't know that they're doing something wrong. And I think that's why people panic, where they'll be like, well, this one company grew from a really small company and became big, but a lot of the regulatory compliance, isn't up to par with a large company. And so again, the costs increase a lot. And so as long as you're paying a good enough price where the downside isn't that much, where if they increase the costs, but then the upside is going back to like business as usual, then I think that those are the times where you find something very attractive. So another thing maybe to look at as an investor is to look at, go back a few years and say, hey, well, what if we went back to 2-3 years ago and had the company performance perform like it was then? Am I paying a good price for this business based off of cash flows or profitability or some sort of proxy like that? And say, well, if you feel like you are, then it was probably a good time to get in. And over the long term, you'll probably get back at least to that level. So I think that's something good to look at too. Like it's about thinking big picture, big picture, and not looking at, well, look at this little incident that happened here, or this could be wrong and this is bothering me, or scaring me into buying this stock at this time.
Right.
So.
All right. So again, Sam, thank you again for writing this article for the magazine. Before I let you go, real quick, what are some, we're right here in the beginning of January 2020. Anything that's exciting for you going on this year that you're looking at from an investor perspective? We can talk personally, but at least from an investor perspective.
Everyone always asks me about the market and about, should I invest in the market?
I was careful not to ask that. I'm just asking your, what's exciting to you?
But let me tell you what's exciting is that in the microcap space, there are so many companies out there to look at and to find. Right. And everyone's like, oh, should I invest in the market or not? And I always give the analogy to real estate. And I say, I live in Beverly Hills, in LA area, and real estate here, there's a few trophy properties here that are very, very good. And I can guarantee you in 10 years, they'll be worth more than they are today. And that's but the thing is, there's not as much supply of properties here than there are microcaps. So microcaps, in North America, I think there's like over 10,000 microcaps. If you go across the world, it's even more. So if you're telling me out of those 10,000 or more companies, there's not 15 or 20 that are really exciting and interesting investments, and you can't find that, then you're not looking hard enough. Mm-hmm. And so that's what I find really exciting right now, is that I feel like I have a good amount of good investments that I think are worth more than they're trading at today. And so for me, that's what's really exciting for 2020. is to, hopefully they pan out, and get the value I feel that they deserve this year. If it takes longer, that's fine too. And if things change in the businesses, then, time to sell it. So, I'm excited about some of the opportunities that I have in my portfolio.
Perfect. Well, Sam, with that, where can my audience go and find more information about you and Ridgewood Investments?
You can go to our website, www.ridgewoodinvestments.com. You can, follow me on Twitter, S Namiri. I believe that's my Twitter handle. Yep. And you can, add me on LinkedIn. You could send me an email, sam@ridgewoodinvestments.com. And yeah, those are probably the best ways to reach me.
Perfect. Sam, thank you again for joining me, man. Look forward to the next one.
Thank you, Bobby. Likewise. Appreciate it.